Hey all, in this section we will look at an introduction to monetary policy. Monetary policy has a powerful influence on a nation's economy. When the economy is going through a recession, the central bank comes forward and reduces interest rates and makes more credit available. This is called expansionary monetary policy, which as a result will increase investment. I is for investment, which will increase aggregate demand, that is the real gross domestic product, and increase employment. So here we have the chapter outline. Just to let everyone know that money, loans, and banks are all interconnected. The savers are depositing their money in their bank. The banks are loaning their money to businesses, individuals, other banks who are the borrowers. The government of every country has public policies that support this system of money, banking, and loans. However, if this banking system does not operate smoothly, the economy can either fall into a recession or suffer prolonged inflation. And herein, monetary policy comes into play. So, when the economy is suffering from a recession, the interest rates, just going to write this as interest rates, this goes down. When the economy is going through a period of prolonged inflation, the interest rates go up. So this is basically the take home from this chapter. Okay. All right. So this is really interesting here. Now I'm going to look at the central bank, which is an organization responsible for conducting monetary policy and ensuring that a nation's financial system operates smoothly. Each country or economic zone has a central bank. We have the European Central Bank, we have the Bank of Japan, we have the Bank of England, which is the central bank for the United Kingdom. For the United States, the central bank is called the Federal Reserve System, or the Fed, which is a semi-decentralized sector mixing government appointees and representatives from private sector banks. The Federal Reserve System is run by a board of governors consisting of 7 members appointed by the President of the United States and confirmed by the Senate. So as you see here, Janet Yellen is the first woman to hold the position of chair of the Federal Reserve Bank. Now we have a new chair, and his name is Jerome Powell. We have 12 Federal Reserve districts, and it's quite interesting to look here how we have a cluster on the East Coast and we do not have a lot on the West Coast. Alaska and Hawaii are part of the San Francisco district. And each of these 12 regional Federal Reserve banks are responsible for supporting the commercial banks and economic in that district. Now, what does a central bank do? The central bank is responsible for conducting monetary policy to promote stability of the financial system. These first 2 functions are so important that we will discuss this in their own modules. The third function is to provide banking services to other commercial banks and depository institutes. So, what are examples of commercial banks? The Federal Reserve Bank is not a commercial bank. The commercial banks are where we bank. As for example, Wells Fargo, we can also look at Chase, we can also look at the Bank of America, where you are depositing your money, and if needed, we are taking out our loans from commercial banks. So, the Fed is providing banking services to all these banks that we bank, and it also provides banking services to the federal government. By point 3, we mean the Fed ensures that enough currency and coins are circulating through the financial system to meet public demands. As for example, each year the Fed increases the amount of currency available in banks around the Christmas shopping season and reduces it again in January. Pretty interesting. Alrighty, that's all with the introduction.